welcome to the show. Thank you so much for tuning in Smart 24 TV, where we drive your business. My name is Anthony Sebali, and I am your host. This is Financial Markets, a show in which we delve into, of course, matters concerning investment, especially in the passive income that comes from investing in financial markets. Remember that for you to make money nowadays, you don't have to go to work every single day. You can use your savings to make money for you, and that's what this show is all about. Today, we have a very special discussion and a special guest with us. Collective investment schemes have become indeed very popular over the years. Now, a series of reports from the Capital Markets Authority indicate that the schemes have been growing over the years in terms of investor base, but also the assets under management. In the first quarter of 2024, the collective investment schemes grew from at least 2.2 trillion last quarter of 2023 to a tune of over 2.3 trillion Ugandan shillings, a growth which has been progressive, over 1.6% increment as per the statistics from the Capital Markets Authority. Now, what is driving this growth, and where are the benefits that these investors are actually seeing that you might actually not be seeing? Tonight, of course, I'm joined by a very special lady, Madame Dora Perpetua Babidie, who is the head of business development at the ICA Lion Asset Managers. These are also fund managers, and they help you invest in this particular scheme. And she'll be sharing with us some of the probably potential benefits that are in this scheme, but also some potential risks that could be ahead of this scheme. You're most welcome, Madame Dora.
Thank you so much, Anthony.
I am very grateful because it's been a while since we last met, and almost, I should say, Happy New Year.
Happy New Year's.
Thank you.
Happy New Year's, because there are multiple. Thank you so much. And thank you for the great work you still continue to do with educating and informing our citizens on how they should be able to handle their investments, but as well as grow and become better, both on an individual level, family, and then outrightly as a nation.
Absolutely.
Yeah, so well done.
Thank you.
And so my name is Babidie Dora Perpetua for the record, not Perpetua.
Yes, okay.
So yeah, and I bring you greetings from ICA Lion Group. ICA Lion Group, we are located at Treasury Courts. We have three companies in one. We have the general insurance company, where you put your short-term kind of insurances. That's workman compensation, your comprehensive. I think it has the best Simba.
Yeah.
You
sure.
don't, it's different. You don't get to pay any excess. It's literally, you pay that anytime. You have a problem, they can't sort it in time, they give you a car equivalent to your status.
Yeah.
Yeah, so,
Wow.
but it's given to people that are above, the car must be above 20 or 25 million. I'll do a cross check. Yeah, but very, very good product, no headache. And basically that's general insurance. And then we do have the life assurance company. That confuses people a lot, insurance and assurance.
Yeah.
So the life company is basically, it insures life. Yeah. And that's why the bare minimum of any policy is 5 years. For our education policies, for the Toto, we have the Toto, we have the Investor Plus, we do have the endowment, really, which gives high profits. And as you have been seeing and following the insurance regulatory body, they're really on top.
Yeah.
They're the first,
That's
the
right.
biggest in the market. And I say it, you're supposed to be smiling.
Absolutely.
And this has been year in, year out, and there's tremendous growth, really. And then we have the asset management company, where we host the capital markets. So we are totally independent of each other, different regulators, different leadership, corporate governance, everything is really independent. The only thing we share is that it's the same shareholder, the First Chartered Securities, that owns ICA Lion Group with the different units, both Kenya, Tanzania, Uganda, and then in Kenya we do have the trust company as well, for people who really struggle with administrative kind of things, latest state administrations and all those kind of things. Yeah, and then also Kenya, we have REITs, which is the real estate, which is not maybe in Uganda. We don't have the REITs because of our regulatory.
I hope they're coming soon, because they're also doing quite well in Kenya.
Yeah.
And I think it's high time we also advance to such products.
Capital Markets is here.
Absolutely.
It's working tirelessly, the development team. And just like we didn't have dollar solutions in terms of interest, and now you see that people have launched, and we do have them. So I'm sure even the rates will follow. You're
definitely going to tell us about the dollar unit trust. I'm very interested. I'm sure my viewers are as well. But let's start our discussion. First of all, looking at the statistics. Yes, they give us very good numbers. Looking at how people have become more attracted towards these collective investment scheme vehicles, it's insane, because when you look at the equities from the USE perspective, we don't have as much growth, right, in those individuals. When you look at also the other specific corporate bonds, treasury bonds investments through maybe banks or these dealers, we don't have as much growth as well. But as per this year alone, we're having over 2.6 trillion from the first quarter of the year 2024. That's an insane amount of money. And then that is a growth of over 15% from 2.3 trillion last quarter. And the story goes on and on and on. First of all, why have they become so attractive? And what do you think are some of the reasons these investors have been growing in number and in value as well?
So if you look at the trend of the market, I will speak broadly more on the market for benefit of the client and then skewing it to ICA. So when you look at the trend, initially, when collective investment schemes, they've always been there. It was a matter of literacy, sensitization in the masses, to be able to understand that who consumes collective investment schemes and what are they anyway. When you say collective investment schemes, what are they? They are pooled funds, It's a collection of all sorts of pooled funds that have different objectives to an investor. It could be long-term, short-term, or it could be low risk, medium, long. So all these factors define the kind of fund that you end up with. Am I low risk, but I want competitive returns, no taxation, would put you in money market. You want high returns, which definitely takes us to high risk exposures as well. Then we could look at growth funds and equity funds in that space. So when you look at initially why they haven't been an uptake of them, basically you can agree with me for the number of years that you've dealt with now financial education, that it was a place of ignorance. People were not aware. And we all know that there are products that need a lot of information for one to arrive at the decision. For example, money is one of those products, because we deal in money. It's one of those products that someone needs a lot of information and comfort to say, oh, I can take my money from a traditional bank and give it to a fund manager. Fund management is not a concept that our African countries are very, very comfortable with. Maybe South Africa and Nairobi, and you can see that in terms of streetwise, they're faster. They're faster than we are in everything. So in Uganda, the population that actually has the money had failed to pick up and understand the concept of fund management. I remember doing a pitch in Kasita down there. I got the all the bagagas, put them in a room, put in a lot of money, explained in Uganda. I spoke all the Uganda you know in the world, and I was
because you knew they had the money.
I can assure you, by the time I was done, the first 3 questions that came through, I said, we need to go back and rethink. And the questions were, Mama, Nzidinam, Oli GNLD? No, not GNLD, it's called what? The forever, like, kind of equivalent trading. Forever living products. There's another equivalent that is like them. So that's what they were equating me to, network marketing, right? And of course, so when they don't hear my loan, a facility they can take from you, you're not a bank that they walk into and deposit their money. Now, who are you? Are you not a Mufele? And also, that was at the point of rise of Ponzi schemes that it became very hard for us to penetrate and convince them that this is the regulatory side against the Ponzi schemes. But over time, it's been a story retold and retold and retold. And of course, with testimonies of people around the society that have invested, we see change in behavior. So for me, it's more of attitude changes and the collective togetherness of the industry, spearheaded by capital markets.
That's right.
They've had lots of financial literacy caravans across the nation, up country, within Kampala, to try and position and say, look here, it's not ICA, it's not the competitor, it's not anybody else. Why I'm saying ABCD is because I am not paid to speak about the other brands. But then, yes, you understand that not all the players, it's not the private sector of that particular player, but it's us, the government, saying that this is good for our citizens. And that's, we've seen uptake increase, we've seen confidence boosted, and that has partly explained the increase, but as well as the ease in distribution.
Yeah.
I'm up country, how do I enroll? I mean, how do I send in my money if I don't have to go to the bank physically and then deposit it?
Yeah.
What's the distribution and the payment platforms and distribution channels have also increased. So you find that it's easier now for people to hear about them, to contact financial advisors in the market, and then make the informed decision.
I absolutely agree with you. The innovation in the sector has also grown, and you've made it so easy for students, for working class, for everyone to be able to access this, and that's very much kudos to you. Now, can you explain a little bit of the benefits of investing in a collective investment scheme rather than individually investing in these asset classes? Of course, like I mentioned earlier, we have our equities, we have our bonds, and you do invest in the same products.
Yes.
But then people find it much harder to actually go that way alone. They would rather go through an investment vehicle like the collective investment scheme. What is the catch? Where is the catch when it comes to the collective investment scheme?
Yeah. Thank you, Anthony. I think outrightly, there are very many benefits, but the ones that speak immediately and drive the point home is when you go direct to, let's say, the central bank to purchase the government securities, for which it's anyone's right. It's the process. In the current age and era, everyone is trying to cut short the process. So if I have to go through you, I need an SDC account, I need a broker, a dealer, a trader. There are not very many, not everyone is able to not every bank or not every firm is licensed to. Then you need that account opened up in that particular licensed bank, and then they are able to bid for you as and when the treasury bills or bonds have been released. Yeah. So you don't have so much control over it. And it's basically, it also works in a way that there is the primary market that sets pace for the secondary market. And what we call the primary, it's divided into the competitive tier and then the non-competitive. So competitive is where you have insurance companies, all the big companies that collect money, take up these products first, priority. And if there's a deficit,
fund managers as well.
That's what I'm saying. So when there's a deficit and they still need for the central bank or the government to collect more money from the society, then it's this difference that is released in the non-competitive tier. So you find that in this particular round, we had about beginning of end of last year, I think Q3, Q4, about Q3. The bonds were really good, the 20-year bonds. We saw them shoot up to 18, 17.5. And people really, really wanted them. But you see, there would be a cutoff to how much they needed to take in. So you find that if this difference, you don't qualify on this round, who knows that the next release will also be as juicy as the previous one. So you run a risk of losing out on a good high investment because you are going directly. That's one. While the people that actually, whose money we had within the collective investment schemes, or even those that came after, you still find that they're enjoying the same returns. Why? You're joining a pooled fund. Even then, Anthony, when you join now, you're going to enjoy economies of scale.
Oh,
I invested many years ago on 20, on 18, 17. Now, even when I'm investing on, let's say, 10, 9, it's not affecting me. It's not affecting you because I'm taking the average of all my assets invested. So you are literally enjoying a higher return based on the pooled fund and economies of scale that existed even way before you joined, while the other person going direct will only receive, if they're trading at 11, that's it, 11. And when the market shifts up, you've locked up. The investment schemes allow you flexibility to withdraw your money and make another informed decision and say, the trading right now is not good. Maybe I can inject my money in cattle. Maybe I can inject my money in, I don't know, something else, another alternative, as I monitor the rates. While when you go direct, you have locked up that money. So imagine, Anthony, yes, you want to buy the treasury bill at 20. It gives you a high yield at 17.5, let's say, or 15, fair enough. And the taxes for 20 year, for 15 and above are about 15, they were reduced, yeah? And for collective investment schemes, there are no taxes.
Yeah, that was a debate.
Most likely,
there was a debate about that.
Most likely when you look at the no tax and slightly performance close to the net of a 20-year bond, where would you go? Do you want to lock up your money for 20 years? And you're getting, maybe the difference is about, let's say, 2%. And usually the reason is it's safe, it's government. That's true, but also the collective investment schemes invest in government securities. And they're regulated by the government.
The safety as well.
Yes, and they are safeguarded. But yet you are open to them. So I think flexibility to have access to your funds anytime you want. 24 hours you receive your money in case you withdraw, and you're not locked in whether you're withdrawing part or not. There are no penalties.
No tax.
No tax, no management fees. We do, it's a 2% overall on pooled funds, on assets under management. It's not on you, Anthony, it's on the performance for us to give you a competitive return.
It's on the interest, rather.
Literally, we should be saying that. But ideally, if there is no performance, it would not be on interest. But ideally, given the spread out of years from when all these fund managers started, there can't be a place where there is no performance.
Absolutely.
And basically, I think that's it, the flexibility, the control over your money to make those decisions as and when, the no taxes, the sleep. You sleep and know that this risk of whether now to have missed or they've traded for me or I don't know, it's with the fund manager. Every day we wake up to do this, and it's our role. They
do the homework on your behalf.
Yes,
that's amazing. That's amazing. I would totally agree. However, there's been a concern with also the amount that is required. Is it still a minimum of 100,000?
Yes,
it's still a minimum of 100,000.
Much less even for other players.
For other players,
we have a player who is at 10,000. For ease of mobile transaction. Ours has been lowered to 30,000 with the DigiTrust app. Top up is 50. No, the minimum top up is also 30, 50, 100. So
let's talk about how the mechanism of the scheme. Yes, someone could be watching out there and they're hearing all this, but they're still like those traders you met. They still have that question, who you really are and what you do with their money. Let's talk about the basic mechanism of how the scheme works. So you have people coming in with money, different sorts of amounts. Some people millions, others hundreds of thousands. How do you allocate and how do you calculate the return? You mentioned earlier that whether or not you come in at, for example, that rate, when the rate was at least at 17%, and someone comes in later, they will still enjoy the same benefits. Some people might look at that as unfair. Others might look at it as something that is very, very beneficial for people that are coming in. So could you explain the mechanism of how the scheme works and how you ensure that every investor gets a fair return?
Okay, so in as much as I could have cited that everybody, you get to enjoy the economies of scale, definitely everything is proportionate to the time frame, the amount, and then the seasons, So of course, if I have been in the fund for 2 years, for example, and you've just joined for, let's say, 1 month, yes, I'll give you the equivalent of the prevailing rate of that fund performance, which if it's 11, everybody in that fund is getting 11% proportionate to your contribution. Maybe to break it down, I love using actual figures. When I get somebody of 100,000, I get another one with 1 million. I get another one with 10, 100, 1 billion. I like the fact that the beginning number is 111. You just keep adding 0. So if we do 11% of 10 of 100,000,
that's about 11,000.
Exactly. So if this is 11,000, okay, this is what will be due to the one of 100.
Yes.
So if I come to the one of 10 million, I'll add
1.1.
I'll add a 0
Yeah,
on the other
right.
11.
That's
Yes,
right.
true. Yeah. I'm taking our viewers slow. I'm not depending on you and your and your quick, So when I go to the one of 100 million, I add
another 0.
0, and the one of 1 billion.
That's right.
First, tell us the one of 1 billion.
That's 100 million, 1 million. Yes.
110, and then this one of 1 billion.
That should be what?
11.
Yes, 11.
About
Yes.
11. Or so you realize that everybody earns
100%.
according to what's proportionate to their contribution in the fund. Same applies to how long you've been in the fund. You can't earn what you were not a part of. We start counting from when you joined. The next day, it's always +1. Yeah. So when you look at if you join, also when you withdraw, the same applies to the withdrawal. If you withdraw, let's say 15 days into the month, we will actually give you interest due to you for the 15 days. The number of probably years you've been in up to the 15 days you've withdrawn totally, or if you withdraw part, we'll compute what's due to you for those number of days, and so we'll give you, let's say, 2 years and 15 days.
So to understand this, you have an annual rate, which you break down into a monthly rate, and then a daily rate. And so any point in time that the investor wants to withdraw, you calculate how much is due for them in that particular period, no matter how many days.
Yes.
Oh, that's amazing.
That's how fair. That's how transparent. Going back to your first question, what has caused the growth? The level of transparency and the level of simplicity of understanding actually the mechanism, because every time somebody understands, it's easy to make a decision and come on board. How
do you ensure that there is transparency and, of course, honesty in the capital markets, especially because we are living in the day and era of Ponzi schemes? Yes, the Capital Markets Authority has put in place mechanisms to see that they fight them, but they're still here. We've just had one close recently. BLQ was around, and people still run for these.
They still do.
And sometimes they mistake these fund management firms and so on for Ponzi schemes. So how do you ensure that there's transparency and honesty, and that actually every investor is satisfied with your service?
Okay. So in terms of transparency, again, I'll go back to, and maybe try to explain the structure of fund management. How does it work? Who is a fund manager? Who do they work with? So you realize I'm speaking money, and I'm taking money from the community or from the citizens, right?
That's right.
Anything that allows me to take money away from the citizen of a nation must be regulated. So I must have an authority over me. That's the Capital Markets Authority on this other side of the collective investment schemes. On the other side, I also deal with pensions, retirement benefit schemes.
Oh, yes.
Or what you'd call, others call them provident funds, gratuities, anything in package of retirement, preparation of an employee or, a particular group, even if it's informal and they've come together to try and create their voluntary side of NSSF for their retirement. I do manage such funds on the other hand. So that way, I'm regulated by UBRA. That's the first layer of security and transparency. So just like banks, commercial banks, they do have reserve funds with the central bank that Uganda Deposit Protection Fund, and so many other funds that they subscribe to with the central bank to ensure that, one, their capital requirements at any one given time can cover the risk on the assets under management by any bank. So it applies to us as well with Capital Markets Authority.
You do have minimum capital requirements?
Yes,
okay.
yes. You come and say you want a license and you see. And then two, we do have a structure in place. I'm not a deposit-taking institution. I can't take money and hold on to this money. My role as a fund manager is simply to wake up and invest, look at the assets across the markets and look at how do I blend them, which decision do I make to give a competitive return to my clients, retain them, but as well as be able to make substantial sense of the business. So it means that that's what I wake up to do. That's what I wake up to breed. So within the fund management, I'll have, of course, the likes of Dora's into business development, but I have the chartered financial analysts that are analyzing these things and looking at the investments. Then I have what I call a legal representative of the community, which is a corporate trustee, and that's KCB Bank. They're not very many licensed. For a long time, we've been having KCB. I'm sure about 2 others have listed and have been maybe given license. They'll be coming up, which is good for the market, but it also explains the growth. So you see even service providers are actually flooding the market. So KCB cannot allow me to credit anyone's statement without them viewing it and knowing that my investments were worth this, and the distribution, the money collected, the returns are worth, let's say, 20 billion. And who are the people that contributed to this particular investment? A, B, C, D, company, this circle, what, church, and everybody, how much was their balance at this particular point of investment? This is it. So what do they get? Remember the 11, the 110, the 1 million, and the 11 million that we talked about?
Yes.
Then they look at it that have distributed and then have to confirm as trustees. Then I do have auditors. Every 4 years, we switch auditors. Ernst & Young, the big 4 really, are the ones that you can have as a bare minimum of these schemes. And then I do have what you call the custodian bank now. That's where the point is. I'm not a deposit-taking institution. You don't give the money to ICEA.
Yes.
Yes, but I am taking away money from you.
That's right.
So you put this money in the custody bank. So every...
There's a trustee bank, then there's a custody bank.
Yes.
So literally you have no hands on this money. It's entirely... We're going to take a quick break. And when we return, dear ladies and gentlemen, we are still discussing the progress of the collective investment scheme in Uganda, which has become very popular as an investment vehicle for different investors looking at short-term gains, but also liquidity. My name is Anthony. I'm with Madame Dora. Please don't touch your dial. When we return, we're also going to talk about the dollar unit trust. It's something new, and we need to discuss it with Dora. We'll be back.
My friend, just enter. Everyone now has all access to Pearl Magic Prime. Kasim, give this man some biscuits.
They're over.
They're over.
ladies and gentlemen, and thank you so much for staying tuned on Smart 24 TV. We are here in the studios at Plot 42 Nile Avenue, coming to you live. And I'm with Dora Babile, who is a fund manager, and she's representing ICEA, Lion Asset Managers, one of the most profound fund managers we have in the land. And we're discussing the collective investment scheme, one, for its popularity. If you're out there and you don't know about this, I don't know where you're at in Uganda, honestly. I don't know where you're keeping your money. I don't know if you're still putting it under the bed, but we do have a scheme under which you can actually invest your savings to get a return daily. And then on top of that, you will be able to withdraw that money whenever you need it. We are in the school fees season, and so many parents are looking for money. Some investors who have invested in the scheme are withdrawing right now as I speak. And this can happen 24 hours a day. So it's a very exciting movement. But of course, it doesn't come alone. It comes with a little bit of risk and also a little bit of knowledge, which you must be able to uptake. And now let's talk about Dora, the regulation. But before we go to the regulation and oversight, before we went into the break, you were talking to us about how protected the investor is and how you don't touch this money. You have a trustee bank, you have a custodian bank, and all these other hands that get to touch this money. Tell us about, first of all, the impact you have as the fund managers on this amount of money. Because at the end of the day, you're not getting in direct contact with the money, but then you have the say in as to where is this money is going. So how far can you go with the investment? Does the KYC you give to the client when they come in the first day, is it the basis that you're going to use to invest, or you actually call in to consult, or you do this entirely on your own?
Okay. I'll try to see if I am getting your mind on what you are asking, which could be how far as a fund manager in terms of my role do I go into the fund, for which actually the fund is called, for instance, when you look at the money market fund, it's just not called the money market fund, it's called the ICA Lion Money Market Fund. Pension is called ICA Lion Teleca Fund. So meaning the name of all these other partners is ICA, and yet I don't take the deposits myself. So yes, like I told you, the separation of duty is an international practice that we all subscribe to, and it's safe that way, and that's the structure. And so when now ICA, now you're asking me to open up the background. In the sitting room, they're getting to
know what's in the kitchen.
What's in the kitchen and how you cook. But anyway, I'll try to break it down for us to understand. So when we collect the money, ICA is the front face in this, because we solicit the business. We talk to the clients, we advise, it's called financial advisory. And when the client finds the need or has the objective we need to meet by helping them earn this passive income using their money, then they entrust us with the money and they want to enroll. So yes, we do take them through the enrollment process where we collect all this KYC. He's misleading me. Know your customer.
Yes.
And so in the know your customer, I will know who you are, how old you are. I also have a bit of a risk profiler within my application form that then will inform me. I see your ID. I see a lot of information, personal data, financial information about
risk appetite.
Yes, risk appetite. But I also ask for your financial, your proof of your statement for this particular account in case I have to pay you back. Or in case you're sending money to me, the account in any bank, really commercial bank that you're based in. So when I look at that, I am literally profiling that, one, you're not integrating illegal money into the system. So anti-money laundering has been a very big thing for Uganda. And then two, I'm able to understand how old are you and what fund are you going for. It would be very unprofessional of me to look at a person whose answers have been Anthony. Anthony is give or take 75 years or 70.
No way. No.
The other Anthony,
Okay.
Anthony Senior,
Nice.
is 75 years, right? And Anthony, also I'm able to look at what percentage of the money you're giving me, what percentage is it of your overall total life savings. So if you give me in that answer 50%, 60%, or everything 100%, as a financial advisor, something has clicked. You're 70 years. This is 50% of your entire life savings. And then you're going in for an equity fund, which is long term, over 20 years, 70, 80, 90. Then the objective, I'll look at the objective. Then I'll also have follow-up questions like, have you ever invested in collective investment schemes before? Or have you ever invested in an equity fund before? The reason why I'm asking you these things is to gauge how much information you know about where you're going. It could sound so good, but is it real for your life, for your current life situation? Yeah. Will you need this money really? Can you wait for it 30 years if it went into an equity fund? Or in case equities have dipped? We've seen equities in East Africa, they have been struggling for quite a while. Maybe not struggling, but not as yielding as the expectations of investors would have been. For me to look at my money for 20 years, 30, I must be able to smile to my account and say, yes, I put my money in shares. But we've seen the counters struggle a little bit, and then there are not always very many listed companies coming up. So there's saturation in there, yeah? And investors are stuck a little bit. So the dividends are not as juicy and healthy as probably it could have been from the word when they set out to invest. So do I put a 70-year-old Anthony Senior in that fund? No. So that's on the side of relationship and advisory, that's how far I go. On the side of my custodian, since I'm not taking this money, but I'm still the brand that people know. If anybody had a problem, it's me, they will be saying. They don't know all these other partners on board somehow. They should be knowing them, but we have a saying that you mind your business, you mind the one who came to you. You just need to know where ICA is.
And I think that's the goal of the CIS,
yes.
To try to get rid of all those middlemen.
And so when I look at it, also them, yes, I command them. Because at the forefront, I am the sponsor of these schemes. So what they do, they can't invest for me. So any bank is not a custodian. There are few custodians on the market. Many banks, but few listed custodians. So under securities and custody, they're holding on to this money under securities and custody, not under traditional banking. So this money does not reflect in their balance sheet. So it means at any one given time, this money is safe. And I don't have it. And they don't have it, and it should not reflect in their balance sheet. Unless I have subscribed to them under deposits. What we call the fixed deposits. Or there's what we call near cash. In case I've kept this money with them to get a little return for my outflows. And maybe they go down. That's money I've given them as a client. Now I've become ICA, a client to them.
Yes.
But
they're not your custodian.
Yes.
That's right.
But on the custody level, they're holding on to certificates of treasury bills, of bonds, issued certificates of the securities.
So this custodian must be dealers.
Yes.
All right.
Well, I don't
Not
know the
necessarily.
criteria they take to give them the custody license because it's different. It's different from securities and custody. So we only have a bit Standard Chartered, I think KCB, Stanbic, big as it is, just acquired the role, which was Liringish from Barclays. And then we do have, who else? Who else is a custodian? So it's housing finance, which is also quite new. So in the longest term, we've been having Standard Chartered and KCB. So you find that they have systems how to manage and pay real-time credit people's accounts, and then, all good facilities, of course, technology and innovation gets into play. How fast will give me seamless services for my customers.
That's right.
But they don't have this money. And they take instructions from us that ship maybe 10 billion to treasury bills. Ship 100 billion this particular bond purchase. Ship this, and there's no money there. Every day when money comes in, it must be invested by the next morning.
The next morning.
Yes.
Wow, that's amazing. That's a very elaborate explanation, and I think our viewers should understand the fact that yes, they manage the funds, but they do have a custodian, and that custodian, their role is to make sure they invest these funds. It's not them to decide. It's still up to them. And I think you do have a team of research analysts and
chartered financial analysts.
Yes, and I think you're one of them doing that amazing work, seeing that they know exactly which bond is going to have a higher yield, when and how. That's their role.
Yeah.
And so that's a very good move there. Now let's talk about the types of collective investment schemes. Yes, we know there's a money market fund, and we're going to explain briefly what it is, and an equity fund, but also the dollar unit trust. It's something new that we're seeing on billboards of recent, which we might need to understand. You know, every time you have these new products coming in, they get to confuse people a little bit. And you know, we are still at a point where we need more and more and more people investing, right? So get to explain to us some of these products and the difference between them.
Okay. Thank you, Anthony. So I'll just say, I'll break them down. Also, I'll speak not as Dora in the industry, but I'll try to wear the hat of an investor, you know, watching these. What are they? What are the different types of collective investment schemes, or what are the different funds, pooled funds that make up the collective investment schemes, and how does one know which one to take up?
That's right.
So we'll start from the fact that what's your need? What do you want to achieve? What's your objective? Everything starts with a goal, and then we set the different smart objectives to achieve the goal. Yeah. So you want maybe financial independence, whatever that means.
Financial freedom. The women love to call it financial freedom.
Financial freedom.
Yes.
Whichever way it looks to everybody. Others want it's capital preservation. Others at capital accumulation, build.
Yeah. Business.
Anthony wants to marry a girl. And if
wedding plans. Yes.
If she takes that Chitovu Masaka road past there,
yes,
he needs to really put aside money in a particular fund to know that the cows are going to ask for. And as much as these days, I think dowry has lost it. But anyway, either way, to be a respected in-law, and also to give respect to the people that have nurtured this person going to nurture your home. Yeah. You don't go empty-handed. Yes. Yeah, you don't go empty-handed.
With a thigh.
Yeah, you go and say thank you, and you show potential that
that's right.
By the time you took care of them and they look like this, I will continue and do better for the rest of their life to retirement. And what does that look like? Because now you're having this person, yes, they're done with education, they're working, but they're actually now in their prime years of consumption, of independence. You know, they feed. And they're just not feeding, but they're feeding. They are aware. Honey balanced diet, honey gym, honey. I won't talk about these things. I'll just shake them. So it's so different people, different age groups have different objectives. So if your objective is probably to save up and accumulate capital and get to a place where you can have what we are now commonly calling the side hustles alongside your corporate job. Others entirely are not going to get into corporate. It's the hustling their way into, you know, being the investors that we work for. So that then speaks into, do I go short term? Do I go medium term? Do I go long term? So each product is named or is invested according to the needs of those particular clients. So money market fund is one of them. The ICLIN money market fund will work as a representation for the rest of the industry. And so it's short term. Basically, we look at treasury bills up to 12 months, which is 1 year. You won't find bonds in that fund.
That's right.
And unlikely, really. Unless those ones 2 years writing off, like, you know, it's a good deal, and, you know, but it should never be long term, because still 2 year bonds are not long term.
Does that also come with the amount of money? Is it that it's only for small amounts of money?
No. You can put your 10 billion, your 1 trillion
That's right.
in there.
And you have
It's
the
just
return
objective of the time horizon.
Right.
Yeah. And
What's the return like?
Currently, our return has always averaged out at about 11.5 averagely.
Nice.
Yes,
Nice.
for the money market fund. And that's when I say
Regardless
average.
of the 3 months, 6 months, and 1 year.
Yeah. Good. So when I take all and then take the average performance, just to give a clear picture.
Right.
But I know that on the market, usually people advertise effective annual yield, and then there's the daily yield, and then there's the effective annual yield.
What's
So
the
usually
difference?
you find that people will be confused with, if I'm giving you a return of 11.5, definitely my effective annual yield is almost 13. And so I see people advertising 12.5, 12 point this. I wish our viewers, let me look into the camera and tell you. Now I want to open up your eyes. In these kind of funds, if somebody is giving the effective annual yield, ask yourself, does this apply to me? Am I going to stay in this fund for this period of time? Usually people taking on money markets are using them as parking bay for their funds before the final resting place, before their final needs. Yeah. Before you travel, maybe 3 months, I'm a trader, I'm a business person, and I need to fly maybe to China or Turkey. I think it's the new China now, somehow for Ugandan businesses.
Yeah.
But before you go, where is this money? The question is, where is this money? What value is it getting? If it's in the bank, you're not getting any value. They'll tell you they're giving you 3%, and with all due respect to my rivals, and you questioned me how this is turning out to be very good. It's because of these eye openers. If I'm taking on a fixed deposit, 15% withholding tax, you're giving me 12% per year. You're taking out 15% from the income you've made for me. The question is, what's my net? So if my net is going to be 9 and the money market is giving me 11% net, where would you go?
I know, right.
And in the fixed deposit, you have to run another fixed deposit, or if you terminate this, you forfeit some returns.
That's true.
Money in collective investment schemes, you keep adding on. You
No matter when you
consolidate your
withdraw.
fund,
That's
yes, and you compound. Okay, so you see all these other things.
So whatever interest is earned, it makes more money.
Yes.
That's
And so going back to your question of the fund, the different funds and how someone takes on, depending on your objective, your time frame, is it 2 years, is it 5 years, is it 10, is it 15, are you doing it for yourself, are you doing it for children? You know, all those things are different. So my son is, let me see, my son is turned 6. It still makes sense for him to consume investments of 20 years. I was challenged. I was talking to one of my brothers who doesn't even stay here, but has bought lots of bonds. And, you know, I was like, He's like, I have a fund for the boys. It's called the you like research. SFP 500. It's a global kind.
S&P 500.
Yes, I'll get for you the right. And he told me he invested for them, and they'll have access to these funds when they turn 50.
Wow, amazing. Can you imagine?
I looked at him for someone who's 45.
Yeah.
I told him, had your father made that decision for you? I see a bald head approaching. Up to now, you would still be waiting 5 extra years to have access to this fund. It's like, it does not make sense to you, but it actually does. And says, I took it on because they were very young. But now when you look at their net worth, it's unbelievable. So of course, also the developed countries, that weighs very highly in terms of how long he can be able to get, and the insurance is very, safe and all that. Same applies to our collective investment schemes. They're insured. The professional indemnity covers in case there's an error, in case there are all these things.
That's what they call being planned, eh?
Yeah. But
That's
planned
right.
at 50, even me in the industry, I'm still struggling. I said, for me, when I get them to 20,
Yeah.
25, I'm putting my hands off them. I can give them the bare minimum and then let them
50?
also 50?
Yeah,
So, but you see,
But even
different
20
people.
years, when you look at the return, imagine they are reinvesting and you don't even tell them.
Yeah, he does.
Imagine they are reinvesting all their returns. And they accumulate over 20 years. They might not even have to actually be employed at 25.
That was his argument.
Yeah.
And also, when you look at their nature of housing versus us, it's probably easier to find acquire land, acquire home,
build.
Their mortgages, they are kind of,
it's more complicated.
It's complex. So he's like, by the time they turn 35, when I look at when I have been able to acquire an apartment for myself, and what the years ahead are looking like, I might need to cushion them.
That's
yeah.
true.
And then he's like, if they do well, then I need to cushion, then they might end up in bad retirement. Probably I would have given them a starting point for retirement. The quality of retirement matters after here. So you see where we headed, even in Uganda. Right now it looks far-fetched from my understanding, but I see we are moving towards the developed countries. So it goes back.
That long term, looking at the long term, not just these.
It's going back to what's your objective. Is it short term? Is it mid-term? And I advise our viewers that always have your pie chart and ask yourself the short-term questions. What do I need? How does my monthly look like? Stretch it out to your 12 months. Because now we are seeing from when we had first, look at the quarter is gone. Yeah. Yeah. It's moving fast. We almost passed the second quarter. And so 12 months is no longer a long time. I remember those days you would long for Christmas. Now Christmas comes every other day. You're like,
Before you know
so
it's Christmas.
The 12 months, I don't think we can now think of planning for 1 year. We need now to tell ourselves that the 12 months have turned into 24 months. And how does that look like for your financial needs and objective? Do you need money markets that are short term? Do you need to go to income fund? Now I'm introducing the second type, rather. And income fund, what is it? It invests in bonds, medium term.
That's about 2-3 years. 5 years. Okay.
5 years. 5 to 10. 5 to 10 is mid-term.
Okay.
Long-term investments is about 15 years and above to be.
What do you call that fund?
Income fund, the fixed income fund.
Okay. All right.
Yeah, it's a fixed income fund. Other people might call it a growth fund, a little bit different names to mean the same kind of thing. And so it's looking at those kind of investments, like the 5-year bonds, 5 to 10. They also have a way they behave, and you can still get a higher yield, slightly higher than money market. Let's say if money market is at 11.5, our income fund is returning about 13.5. 13.5, that's not a bad performance.
Not at all.
When a 20-year bond is giving you 17, if you look at it.
Yeah.
Take away taxes, take away the time, the lock-up period, the no control over your money and everything. But again, let's not forget the objective. The objective could be that I'm investing for my children's, university or something. Then that becomes very valid. Then we do have above the long term that can fall into things like equity funds. Equities are shares, basically stock. So, but we all know how they behave.
Volatile.
Quite volatile.
Yeah.
So you need to make sure that you're putting in money and you have an understanding of where you're headed. But also, we advise in terms of alternative investments. Yeah, what else? Offshore can as well maybe not be skewed to equities entirely, but it's a blend, but it's still long-term and equities. Yeah. But you see, you need to look at a
Talking about offshore, you also mentioned about the dollar unit trust. Please go ahead.
So when you look at somebody investing, let's say in Silicon Valley listed kind of situations, Apple, you need to analyze some of these trends and companies. They're not about to go down.
At all. Yeah.
The need for what they produce is still sufficient. That even if they run out of innovation, what are the chances that another one is going to come and outperform the market pace setters? Let's say Samsung and Apple. I'm surprised I've talked about Samsung, but anyway, with all due respect. It's and of course they are there. Different markets have different subtle like brands that have not probably hit the African market. Europeans actually like one called OnePlus. It's an Android gadget, but it's quite fast for the standards of Android. It's really fast. And so you find that, but even when it's that good, there's something that failed to position and penetrate and take the place of the top players. And so, will communication ever stop being communication?
No.
Will you, with this ease, that your brother is seated in another country and you can just go and, hey, yo, bro, what's up? Hey, mommy's here. She's not well. Say hello to her, Jaja.
Yeah.
What? Those days, I don't know whether there were faxes or what telegram. I don't even know how they used to communicate. Yeah. So it means this is not about to go down as a need. Instead, it has to advance. That's why you see we are always revolving. Speed this. 5G. I don't know what 10G. I don't know. My father is an engineer, but he stopped on 3G. Said, you know. And so you find that we need to, you realize every other time that when they release these phones is the speed, the processor, this, that. So you find that when you look, these are things and factors that we look into as fund managers, and then you make an informed decision and ask yourself, really projected 50 years from now. Now for a company like us, it's okay to make investments at 50 years.
That's right.
I just enjoy the on an individual basis. So when you do, you find that these are maybe not on Uganda. The best performing for Uganda is Stanbic. Okay, let's say Stanbic or I don't know which counter. I don't know which counter. But you find that these ones are not about to go down. The likes of Apple, the likes of what? But you may not have the money to invest directly as a person. Why not join a pooled fund and they invest for you offshore?
Dora, we're running out of time, unfortunately. But as we wind down, just one remark on: do we have a hedge fund, or do we have something like the DPF that can synchronize with the DPF, for example, for the banks in the capital markets that can protect investor funds just in case, you know, these fund managers close and, you know, something happens? Do we have that?
Yes. Yes. It's called a compensatory, there's what we call the compensatory fund that is run by CMA. But of course it's directly, so again, that's also another structure. It's directly controlled by the central bank. In as much as the boss of it is CMA, and then the USE, we all, it's a jumbo in there. US is a little baby of CMA. CMA is a boss here, and yet Bank of Uganda is, you know,
a big boss somewhere else.
Yes. And so we do have.
How much? To what extent?
I don't know if I am at liberty to discuss. I don't know, because they don't advertise like DPF. DPF says 10%.
Yes,
I may not speak. I may not be able to speak for CMA. But what happens is that also even the professional indemnity cover I talked about. Every time you grow in your assets, you're tasked to increase your insurance cover. That's right. Just in case. There's any error on people's, you know, investments. And
then you also mentioned you have a minimum capital requirement. So I mean, when are you going to run bankrupt?
We cannot.
Thank you.
Your money is there.
Thank you so much, ladies and gentlemen. I wish this conversation could go on. It was very exciting. And been with Dora Perpetua. Yes.
Well done.
Bavidie. And we've been discussing the collective investment scheme. Please remember to comment, like, and subscribe on our YouTube channel. And we'll be able to also respond to those comments once you get them there. So, for now, have a good night. See you later, and bye.
Smart 24, driving business.